Hey everyone, let's jump right into this explainer. Today, we're going to demystify exactly what makes the ICICI Prudential Multicap Fund tick. Look, if you've been searching for a way to capture the massive high growth potential of small and mid-sized companies, but you still want the sleep-at-night stability of industry giants, well, you are in exactly the right place. We're breaking down the complex market data, the performance metrics, and the underlying risk factors into clear, actionable insights. We're going right under the hood of this specific fund to see if it actually deserves a spot in your long-term wealth strategy.
Here is our quick roadmap for today's explainer. We'll be defining multi-cap funds, highlighting ICICI's performance, seeing how it beats benchmarks and peers, digging into risk metrics and volatility, laying out the key fund advantages, and finally, assessing long-term growth.
All right, Section 1, defining multi-cap funds. Before we get into the heavy data, we really need to understand the unique structural mandate that defines a multi-cap fund in the Indian market. It is definitely not just a slick marketing term.
SEBI doesn't mess around here. It's a hard, strict rule, a minimum 25% exposure across the board, large cap, mid cap, and small cap stocks. That leaves exactly a quarter of the pie for the fund manager to dynamically shift around based on what the market is doing. This is brilliant because it guarantees built-in diversification. You're legally locked into the rapid growth of small caps, the transition phase of mid caps, and that rock-solid foundation of the large caps.
Now, I hear people mix these up with flexi-cap funds all the time. But here's the kicker. Unlike flexi-caps, where a manager can just totally abandon small caps if they get spooked by the market, the discipline structure of a multi-cap literally forces continuous exposure to those high-growth small caps. It completely takes extreme manager bias out of the equation and keeps your portfolio true to its original goal.
Moving right along to Section 2, ICICI Performance Highlights. With the ground rules set, let's shine the spotlight directly on the ICICI Prudential Multicap Mutual Fund.
This fund is definitely not the new kid on the block. It dates all the way back to 1994. Think about how many wild economic cycles that is. Right now, it's managing a massive 18,769 crores in assets under management, and it pulls that off with a super competitive expense ratio of just 0.78% for the direct plan. Now, because of that mandatory small and mid-cap exposure, it absolutely sits in the very high-risk category, which we're going to analyze deeply in a minute.
This is where the strategy gets really interesting. While practically every other fund out there is just piling into financial services, this one takes a bold contrarian bet. They're going heavy. We're talking 28.5% into basic materials and 22.2% into industrials. The managers are explicitly targeting domestic capex-driven expansion. They're basically positioning the portfolio to ride the wave of infrastructure and manufacturing growth, rather than just relying on the banks.
Section 3. Beating benchmarks and peers. Okay, it's one thing to have a cool contrarian strategy, but does it actually pay the bills? Let's look at the hard data. Look at the consistency here. Whether you're looking at a 1-year, 3-year, or 5-year window, the ICICI fund is just consistently leaving both the Nifty 500 benchmark and its multi-cap peers in the dust. I mean, look at that 3-year number, 18.56% compared to the benchmark's 11.89%. That is huge. It proves beyond a doubt that their heavy bets on basic materials and industrials have absolutely been paying off.
All right, Section 4, risk metrics and volatility. Because as we all know, returns are only half the story, especially if you lean conservative. We need to lift the hood and see exactly how much risk they took to get those flashy numbers. Let's do a super quick refresher on beta. Basically, beta tells us if we're strapping in for a wild roller coaster or taking a smooth train ride. A beta of exactly 1 means the fund moves in lockstep with the broader market. Over 1, more volatile. Under 1, less volatile. If you're a beginner assessing long-term capital growth, you absolutely need to know this number.
So check this out. With a beta of 0.92, the ICICI fund is actually less volatile than the broader market, and it beats the multi-cap category average of 0.95, which is pretty wild when you think about it. Half of this fund is mandated to be in jumpy mid and small cap stocks, yet their specific stock picking manages to give you a slightly more defensive cushion.
Next up, standard deviation. If beta is about comparing the fund to the market, standard deviation is about absolute volatility. It's basically the swing factor. A higher number means your returns could swing wildly from year to year.
And again, the ICICI fund clocks in lower than the average, 15.69 versus the category's 16.25. For the conservative folks listening who might be a bit squeamish about a fund in the very high-risk category, this is exactly what you want to see. It proves there's some real, disciplined risk management going on behind the scenes.
Okay, the big one, Jensen's Alpha. This is, hands down, the ultimate test of an active fund manager's actual skill. It tells us how much extra return the manager generated purely through their own strategic choices, totally independent of general market momentum.
And look at this. A massive, category-beating alpha of 5.56, crushing the 4.42 average. This right here proves it's not just luck. It's not just a rising tide lifting all boats. The manager's active bets are creating real, measurable excess value for you, the investor.
Section 5. Key Fund Advantages. So let's pull all these threads together. Why this specific fund over the dozens of other multi-cap options?
The takeaways are pretty straightforward. 1. The strict structure forces that small and mid-cap growth exposure without letting manager bias get in the way. 2. Those contrarian sector bets offer a totally different growth engine than your typical bank-heavy fund. And 3. That Sharpe ratio of 0.74 against the 0.66 average, that means you are quite literally getting more reward for the exact amount of risk you're taking.
Finally, Section 6, Assessing Long-Term Growth. How do we take all these complex numbers, the alphas, the betas, the sector weights, and actually turn them into a real-world game plan? 5. That's the magic number. 5 years is the absolute minimum horizon you should be thinking about when jumping into a multi-cap fund. Why? Because you've got to give those contrarian bets in cyclical sectors time to actually play out across a full market cycle. Plus, a 5-year horizon naturally smooths out the severe short-term bumps you get from holding all those small and mid-cap stocks.
And because we're dealing with that mandatory 50% exposure to mid and small caps, dropping a massive lump sum investment today might give a conservative investor a few sleepless nights. Enter the SIP, the Systematic Investment Plan. It is your absolute best friend here. By investing fixed amounts regularly, you average out your entry point risk, buying more units on the dips and fewer at the peaks. It turns volatility from a threat into an advantage.
So, we've looked under the hood, we've seen the contrarian strategy, the incredibly solid historical returns, and the highly favorable risk-adjusted metrics. Armed with all this data on the ICICI Prudential Multicap Fund, you've got a vital question to ask yourself. Does this balanced yet undeniably aggressive vehicle have a place in driving your long-term wealth creation? Or do you prefer the smoother, maybe slightly slower road of a pure large-cap fund? The data is right there in front of you. Now, what are you going to do with it?